Hello, 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 everyone. Thank you so much for joining Diana's Diary. Thank you, thank you, thank you. Today, again with me, I have, the senior investor. This is, anytime I call on him and he's more than happy to come, I'm so excited because it's hard to find somebody who really knows what he's doing and is so passionate about what he does, and that person is Billy. He's so passionate about what he's doing, and he's willing to empower so many people and give us the knowledge that we want. Last time, those of you that joined, you know how he delivered and explained everything to us. We weren't able to cover all the topics, but today with me, I'm so excited. Even though he wasn't well on the set, he was like,
Sorry about that, guys. Sorry for letting you guys down. I had tonsillitis and I wasn't able to speak. It wouldn't have been worth your time, and I didn't want to waste your time. So apologies.
yeah, it was really bad. But hey, Billy, we
Mhm.
are so happy that you've recovered and
Pleasure,
you
pleasure.
had to,
Mm.
reschedule just to
Mhm.
come and be a blessing to us. And with the good news, those of you that was on the last time, I'm happy to say that two of the people have reached out to Billy and they are in the process. So you don't want to waste time, okay? If you need somebody in this time, this modern time to support you, you need, those people that I bring here is just not anybody that I find randomly. It's just by God's favor, I will say it, because there are
Mhm.
people that have helped me, and I know that they have supported me, in my journey. And that's why I reach out to them by God's grace, and they are more than happy. This is not something that they do. But when I told them about my vision, they are more than happy to help so many people, acquire properties. And that's why Billy is here to support and speak about, what's really going on in our generation, on the system, in the market. So without much ado, I want to welcome somebody that I know, somebody that has helped me as a person, somebody that has listened to me during my difficult time, my hard time in investment, somebody that can help you when it comes to portfolio, getting yourself so much properties. And those people that have reached out to him will bear me witness that Billy has time. Billy has time. So Billy, please, thank you so much once again for coming to
Pleasure,
that
pleasure,
diary.
pleasure is all mine. I know it's been a couple of months, and when was it? Was it in February when
It
we did
was
the
in
initial?
February. It
It
was
is.
in
Just a quick FYI, guys. The average property since our last show has increased by 3% in leads. Just to kind of let for anybody who was thinking about investing, and it's quite natural for first-time investors to kind of toy with the idea and almost, sit by the shore, by the waters, wait for the right time. But had you invested in February, the asset now would have been 3% more in value. And that's not to say you've missed out. Certainly not by any stretch. It's only going one way, and that's upwards. For a quick couple of reasons before Diana gets into her questions, you guys would have probably seen that the Bank of Interest has now dropped their interest rates on the 8th of May. And what that's done is it's reduced the cost of borrowing, and it's increased market activity, in particular amongst first-time buyers. And naturally, that's had a positive impact. Lenders are now starting to almost compete against each other. So we've seen an increased activity in the buying market, which naturally means more demand and the prices start to go up. So yeah, so for anybody who invested in February, you're now 3% more in equity in value. You're a lot more than that, Diana, over a year ago now. You're in the 15%, you're in double digits.
This
Mhm.
is good news. This is good news to
It
me.
is. It is. It
This
is.
is good
It's,
news
it's
to
good. It's good news in the market. The
Wow.
potential for property growth is huge, and the next 18 months has, huge potential. Even the Bank of England is saying, they're expecting the interest rates to come down another 3 times over the next sort of three announcements. So we could be down to 3% base rate in 18 months' time. So it's fantastic news for the market.
But you did tell me when I was scared and all that, you were like, go for that area. And
Yeah.
that's why you are here.
Exactly.
Because
Exactly.
I want you, tell us the honest truth. And I believe you. I know what, you've got on your hands because you've been in industry for quite a long time. Be a senior investor, you know your stuff. And I'm so happy that you've come back.
That area in particular, I mean, there's a lot of areas of Leeds. I don't know if anyone here is from Leeds. You'll find that the north of Leeds is a very nice residential area. So you've got the likes of Shadwell, likes of Roundhay, Moortown, which are nice areas to live in. But the price points really reflect that because you've got your top end property, but then you've got the south of Leeds, the likes of Beeston, Hunslet, for example, which is quite run down. But Morley has its own unique touch to it. I don't know if you're aware, Diana. I know we spoke last time. It does have a train station. It's just recently had a new train station worth over £24 million. But over the next 3 years, what the government's doing is connecting that train station to a direct train to Manchester. So for anybody working in Manchester or commuting to Manchester, you've got a direct train link coming into Morley, a much faster train journey, which again increases demand for that area because residents they no longer have to go into the city centre of Leeds to go to Manchester. It's just a one direct train from Morley. So what you'll find is the dynamics and the logistics of how Morley's been set up by the council through the funding, both private and public sector, it's shaping up to be its own little city. So going in that area now, fast forward 5 or 10 years, you're in fantastic position. You're going to get all the capital growth.
This is good news. Thank you so much. Thank you so much. So today, everyone joining us, we're talking to Billy in terms of investment. If you don't know where to push your money to, that's why we are here. Okay, the world is revolving, and we need to take less risks. If you are taking risks, know that the risks that you are taking is something that it's not too much for you. So. Without wasting my time, Billy, should I start with my question?
Yeah. Fire them across.
All right. So if you come on, we are talking about investment. If there's something baffling your mind and you want to, talk about it, I see Mami Benis. Thank you so much. I see Brother Pat Enterprise. Thank you for joining us. Favorite Mom. Thank you. My Health, My Word, Weakness, Maggie. I think a lot of people are finding troubles logging on, but here, I'll try and post it out later on. But it will be nice just to meet Billy face to face and ask your questions. So I don't know how you guys were able to log on, but if you know anyhow, just invite a friend. Kindly invite a friend to come on because today's section is going to be something, very marvelous, something great. Billy, my first question is, what's your preferred investment strategy? Example, like buy, let, or flip, or commercial or short term?
I mean, what my favorite is, it's more, see, what I do with my investors is understand them. Understand what's driving them, understand what their long-term goal is, because that really determines what the right investment opportunity is for them. So for example, if you're someone who has a full-time day job, doesn't really have a lot of time on hand, can't really travel much because of family reasons or whatever logistic reasons, then going into a flip or a below market value property makes no sense because that requires you to be fully hands-on or have a team of builders, trustworthy builders, which are, by the way, are very, very hard to come by. So if you know any, do let me know. It's a team of trusted builders that can keep the cost down and do the job in the time frame expected. It can be very, very risky. A lot of times you'll find that investors would look at something for which is 15, 20, 30% below market value, but it requires some sort of maintenance or refurb to get it to a standard. That's a flip, yes, but the flip won't work unless you have the capital at hand to begin with. you've got the time and a team, a trusted team to make that happen. So that strategy for a first-time investor may not be the right thing. However, for somebody who's got a healthy portfolio and has the time to put kind of divert towards a flip, that may work in their favor then, because they're leveraging risk against their existing portfolio and can raise capital very, very quickly to be able to finish a job to then refinance, rent, and resell or whatever it is that they want to do. So the right strategy isn't really about what I prefer. It's more regarding the investor and what works for them. What I find is, in a general term, for anybody looking to get into the market for the first time, your conventional buy-to-let residential mortgage, your residential property, is the go-to, because it's hands-off. You can be anywhere in the country or the world, have it managed. You've got a tenant paying an income, it's paying off your mortgage, it's giving you a rental income, and you learn on the go. With property, you can get a person with all the knowledge in the world about property, but you only really learn the nitty-gritty of it once you actually dip your feet in the water. Once you're in the game, you test yourself, because there'll be bits and bobs from different angles coming at you, like you've experienced, with the solicitors chasing them, getting the job done, getting something signed, contracts. You only really learn that whilst you do it, and it can be a stressful process. Buying a property is it's not by any stretch an easy and a simple process. It's very, very stressful. But for a first-time investor, that's probably the preferred.
I just have to give it to you on my platform, City Rise. You guys were very supportive.
Thank you. I'll let Laura know.
I encourage everybody to look out for City Rise.
We've got as I said to you last time, I don't know if the guys from the last kind of talk show are here now. We're not your Knight Franks, we're not your Savills, your bigger companies, but we're very much focused on you, because we understand it's your hard-earned money, and we understand you're a first-time investor. So we've got to make it as simple as possible, so you understand and enjoy the experience of buying a property. It's not just, here's a property, there you go, all the best, crack on with it. It's helping you from A to Z, through solicitors, to brokers, to after sales team, to managing team, the tenants, doing the referencing checks, the vetting them, collecting the rent, being the first point of contact. So you at no point are thinking, gosh, I should have done this. Do you get what I mean? So we simplify the process, bring the right investments to you, get you the right returns, and you just sit on it and wait for capital appreciation.
Like, really, honestly, like the way you are saying it, if someone gets him or herself into that property ladder as a first-time buyer, and you don't really get the good, mortgage advisors or a company to support you, you will be crying. You will be
100%.
You will be weeping.
100%.
But your team will support you, like when it comes to the lawyers and buying, doing the snagging and all that. Very supportive, and that's the kind of people you need.
And look, I'm not in. I don't like kind of bad mouthing other companies, but you guys will find, doing your own research, there are tons of companies out there who don't really put their clients as the priority, or put a lot of emphasis on their clients and their experiences. For them, it's just about numbers. It's about selling a property they're selling. For us, it's not that. It's making sure that you have a good experience and enjoy it, because only then you create good relationships. And I'm a big believer, and so are we here at City Rise, of building long-term relationships. Business is run on good relationships, and it's run on repeat business. You'll find that the most successful business companies out there use the same formula. They prioritize their customer and customer service ahead of what they're selling, because they know if they kind of get that recipe right at the start, everything else takes care of itself. So, and we're exactly the same in our analogy and approach towards our investments. Yes, we bring to you fantastic investment opportunities, but we also make sure that the process, which otherwise can be a very stressful one, is as peaceful as possible. And we kind of hold your hand every step of the way, from A to Z.
Yeah. Thank you so much. That leads me to my second question, which is, how can one decide if a property is a good investment? Because now people are buying so many things.
It's
Bitcoin and all that and all that.
yeah. In terms of, do you mean if going into property against other investments is a better
Yes,
option? Okay,
yes.
yeah. So look, I always refer to this to any client I speak to who asks such questions. I mean, you get a lot of overseas clients who are quite open to investing into Bitcoins, crypto, and other stocks and shares. What I would say is, look, the UK market is stable. It's a mature market. It's probably the only what you'd call a real estate market out there that has shown proven stability through some of the most internationally detrimental markets. For example, we touched upon this last time as well. During COVID, during the Brexit financial credit crunch, you talk in the recession of 2008, nothing has stopped the market from growing in value. And I'll throw some numbers at you again. I did last time as well. 50 years ago, average property price £10,800. Today, the average property price is £300,000. That's a 2,700% capital appreciation. In that 50 years, we've seen everything from interest rates being as high as 14%. Again, Brexit, recession, credit crunch, COVID, you name it. There's been all sorts. But has it stopped the market from growing? It's not. And that's because we're a small island, increase in population, lack of property, chronic housing shortage. It's all around the demand. So, and you'll see in crypto or any other investment, things can change very, very quickly. You have no control over it. I'll give you an example. I have a client who he's got around 14, 15 properties, but he also invests a lot in crypto and Bitcoins and the currency side of things. Now, Elon Musk tweeted something a couple of months ago, and all of a sudden market dropped. You would have seen over £6 trillion in the space of a few hours. That's how volatile it is. A single tweet and your market drops, and you may not be in a position to hold, and that's your life savings, 20, 30, 40,000 pounds just gone down the drain. Now, I'm not saying there isn't potential to make a lot of money. There is, only if you're prepared to take the loss at any given moment.
The volume.
The investment return is a lot slower, in a sense that the money you make is over a longer period of time, but it's almost guaranteed. You won't find anybody who invested 20 years ago is now regretting that investment. It just doesn't happen. They've all made money in a 20-year period, and that's a guaranteed income. So I would say it's a stable and a mature market. You've got huge potential for appreciation. The rental market is always increasing, has done over the past 15, 20, 30 years, and that's only going in one direction. For me personally, I know I have a slight bias towards real estate, but there's no comparison between property and crypto if someone's looking for a stable investment.
Thank you so much. So if you say that, what market or location can one focus on if the person wants to invest, and why? Hello, Billy. I think that you are muted. We can't hear you.
Sorry, I'm just going to connect my headphones.
Okay. Hello, Dr. Pam. Thanks for joining us. Flavored Mood, thank you. Sister Winnie, thank you for joining us. Yes. So, Billy, that leads me to my third question. What I want to ask you is that, so what's the best market or location that one can focus on, and why? Now.
Okay. It's a very good question, and it's something I can talk about for hours. But I'm trying to in my head break it down to be specific and give you a few pinpoints, because again, it's all down to the investor, their attitude towards risk, what their long-term goal is with property. If they just want to be one-off landlord, or do they have the time, effort, money, potential to be a successful landlord or owning 10, 15, 12 properties. So the North, you'll find, and there's a link recently, an article, by Property Wire. They've given a statistic as to where the momentum shift is, and since 2023, I think there's been over 18% increase of investors investing in the north for a couple of reasons. The main one being the stamp duty increase in October last year. Obviously, when you're buying a property down south, the prices are a lot higher, which means your stamp duty is a lot higher. And most first-time buyers don't have an extra 20,000-30,000 pounds to pay for stamp duty. So going in the market up north means you're going in at entry level, and your stamp duty cost around 5,000 or 6,000 pounds, which is affordable for a first-time investment. So I would say that if you're keeping up, we call it keeping up with the Joneses, meaning where is everybody investing? That's definitely in the north, the likes of Leeds, the likes of Manchester, the likes of Wakefield. Wakefield is a really good one at the moment, and even Sheffield's fantastic. York is really good. Hull historically has done really, really well. So anywhere in the north, in an emerging market, you find that's where the momentum shift is, and that's where you're getting increasing number of investors.
Thank you. Someone will say you didn't mention London, and London, anyone talks about where to invest, everyone will think of London. Why not London?
Yeah, I'll tell you why. And again, a very good question. Now, the average property price in London around central area we're talking, in excess of £500,000. Okay. Now, when you've got to put in 25% deposit into a property, if you're buying a property worth £500,000, we're talking £125,000 deposit. Okay. Plus you add in your stamp duty cost, 25,000-30,000 pounds. So the kind of money you'd need to invest into the right property in London is around £150,000 cash. Okay. Now that £150,000 cash, if you can split that into 4 properties up north, now all of a sudden you've got 4 properties, all 4 generating an income, all 4 increasing in value, all 4 diversifying your kind of footfall, your hold on your portfolio. So for example, you never know what the future holds. 2 years down the line, you come into need of some money. If you have one property in London, your whole focus is to sell, refinance, work on that one property. Okay, you're jeopardizing just the one investment that you have. If you have 4 in the north, you can sell one of them, you can refinance one of them or 2 of them. Do you see what I mean? So, and you've still got the other 2 or 3 investments you're holding on to, which are increasing in value. So not only that you diversify your portfolio, you've got 4 different streams of income, all 4 of which are increasing in value simultaneously. Does that make sense? So going into, if we were having this conversation 20-30 years ago, then I'd say, yeah, look, London, it's booming, there's a lot going on, and it has, but we find that for a first-time investor, we've kind of missed the boat. It's more you find the London market is, first of all, very much overseas market now. Your Chinese market, buyers from the Middle East, Far East Asia, or it's for someone who has a successful portfolio and is looking for what we call here a trophy investment, something he or she can boast to their friends about over dinner, saying, yeah, I've got a penthouse next to the Shard or something. So it's more of a commentary investment as opposed to the financials making sense. Because just as an example, the average yield in London is just over 3%, whereas the average yield in Leeds is 7.5%. So do you want to make more money, or do you just want something that sounds good or rosy?
Yeah, thank you.
Smart investors, sorry, I'm cutting you off there, Diana. Smart investors are actually pulling their money out of the good investments they did 15-20 years ago in London and going into the North market now, because that's where the momentum is now. You always go into an emerging market, because as that market grows, so does your investment. London is already there now. Very rarely you'll find any more growth in apartments. It's very much touch and go. You go into Manchester, you go into Leeds, over the next 10 years, that grows. And as that grows, so does your property. And so does your investment. It's an absolute no-brainer.
So as an investor, when you talk about building a portfolio, how important is that? Because like maybe I'm going to buy in London just one, then I have one portfolio. Then I'm trying to think that it's better for me to get more houses to get that stability, or for investors to know that I'm on the go or something. Why is it important to get that portfolio, and why is it important for me to invest £130 as like buying just London to get the money back? And why is it wise for me to get a lot of properties to just get a portfolio? I just want you to clarify that.
Yeah. So again, so for me, it's the diversification it gives you. You put take you for an example, Diana. If you had, £150,000, would you rather have 4 properties to your name, or would you have 1?
4.
You would have 4, because 4 properties would give you more. It'd make your portfolio diverse. It'll give you more options. You've got, again, 4 different streams of income, and you do the maths. For example, a £500,000, £500,000 property for which you need £150,000 for cash would give you in London £2,500 rental income, out of which your £400,000 mortgage would take away in excess of £1,500. So you're left with about £1,000. Okay, that's the income, that's the net. Then you've got your service charge, which in London are a lot higher, some sort of a ground rent, council, there's a whole bunch of extra charges. So you might only come out with just over or just under £800 a month from that one prop. So you've invested £150,000 and you're walking away with, best part of £800 a month. Now, if you split that money into 4 properties in Leeds, for example, each of which giving you £800 a month rental income, that's what is that? £3,600 income. Okay, now a mortgage on that, we're talking £300 per property. 300 multiplied by 4, £1,200 a month. So all of a sudden, you've got £3,600 coming in. Your outgoings around £1,200-1,300 a month. You're walking away with £2,000. So your return on cash invested across 4 properties are a lot significantly higher, as opposed to going into one property in London with just because of the sake of it being London and it's sounding cool and nice. You'll find that smart investors focus on the returns and not so much London. London has come and gone.
Yeah. Wow. Thank you so much. My 4th question. Everyone, I'm asking all the questions. If you want to hop on, just let me know and I'll just will add you. Okay. My 4th one is, how can one finance their deals? As in cash, mortgage, joint ventures. How can we finance it?
Yeah. So the main kind of method would be mortgage. Of course, that's the standard one. Your buy-to-let mortgage, your residential mortgage, but there's also a couple of other ways investors tend to finance a property. And for the ones that have been in the game long enough, understand that buying cash is king. Now, cash is king does not necessarily always mean that you must have the cash in your bank. You could go into the right investment, the right deal, and source funding and effectively act as a cash buyer. So how that works is, say for example, you've come across a property. A friend of yours it's a stress sale. Property's worth £100,000. That's the market value, but they need the money quickly. They want to sell it to a cash buyer for £70,000. Okay, now you've automatically there thinking, right, that's if I buy this for £70,000, the true market value is £100,000. I've got £30,000 profit in there. Unfortunately, I don't have the £70,000 to buy cash. So what you do in that instance is you'd approach a bridging company. A bridging company would give you cash on the basis of what the true market value of that property is. Okay. Now, in this case, in this particular scenario, the true market value being £100,000, you as an investor generally requiring 25% would amount to £25,000, and they're selling the property for £70,000. Okay. It means that you've got more than 25% equity in that property for the bridging company to then say, right, there you go, here's £70,000, go and buy that property, give us it back in 6 months' time. Okay. You now have £70,000 cash. You see what I mean? With that £70,000 cash, you go and buy this property. When you legally own the property, you refinance using the general kind of a method of financing through a bank, and the bank gives you the £70,000. You pay off the bridging company, and you now own a property that's £100,000. You've not spent a single penny out of your own pocket. The bank's given you the money, and you've got a property now.
Wow. This is so good to be true.
Bridging finance. For the guys who are here, do some research on it. If used correctly, if employed correctly, it's a very effective tool. You just need to have the right property for it, a property that's truly below market value, because you can actually get onto the ladder without having a single penny to your name.
Wow.
I've done that. I've done it myself. It's from experience I'm talking.
I know you've done a lot for yourself, and I'm so proud of you. Wow. Is it better to manage your properties yourself, or is better to give it to, property managers?
Again, it depends on how much time do you have on your hand. If you've got the time, then yeah, you save yourself the cost. But you'll find that if you're kind of stuck on managing the property yourself, you'll restrict your investment options to just the location you're familiar with or are from, where you're from. So if you live in Birmingham, for example, and there's an investment opportunity in Leeds, you may say, right, well, I want to manage it myself. I don't want to invest. So what you're doing there is you're compromising a good investment opportunity just for the sake of managing the property yourself. That's why management companies are there. At City Rise, we're actually, you might not know this, Diana, but we've recently been voted the second best management company in the country by Trustpilot. That's because of the service we provide. Our landlords based all across the world and the country, they don't have to worry a single day about having a tenant in there, doing the referencing checks, collecting the rent. It's all done in a timely, efficient manner. The money's in your account as a landlord. So we look after the tenants, we look after the landlords. And I think if you're kind of going into an investment, putting all your money into it, you want to make sure there's no void periods, right? Because if you have a tenant missing for 2 months, that's 2 months mortgage you have to pay physically out of your own pocket. So paying a management team a little bit to manage that property, making sure you have the right returns, making sure there's no void periods, is definitely worth a while.
Yeah, thank you very much. One thing I also want to know, when the property managers are doing it, is there like an insurance company that takes care in case if they are managing it and nobody is in for like 3 months? Who is going to
Yeah.
get that cost? Are they
So
still going to pay you your,
So what you can get there's rental guarantee insurances now. You can actually get an insurance which covers you for your void periods. That's not through us, it's through an insurance company. And no management company can actually give you the rental guarantee insurances. What they can do is give you rental guarantee. So for example, if we have an investor who's maybe not familiar with Leeds or Morley, for example, but they like the idea of investing there, but they're just a bit skeptical about whether it's going to rent, our management team may say, right, so just because you don't know the area and we do, and we know we're going to get the rent we say we are, we're happy to give you a 12-month rental guarantee. What that means is, even if there's no tenant in there for 12 months, you still get your rental income.
That's good. But as a first-time investor, you are not financially okay, you want to climb the ladder, you want to still save more and build your portfolio, and you've just got this property and you are close by the property. Can you just do this insurance yourself and just be checking and maintaining the property yourself so that you can save some money?
Correct, you can, yes.
Okay, thank you very much. How do you manage risks in your portfolio?
In what sense?
Let's say you have about 4 properties, and at the moment there's a lot of risks around it, whereby you invested in the wrong locations.
Okay.
And just maybe one of them is just booming. How do you manage that risk in order to be in line with your portfolio?
Yeah. So, I mean, by the time you've bought your first property, you kind of get an idea as to what works, where the demand is, where the momentum shift is, and naturally, any subsequent property that you buy will be effectively better than the one that you bought before. That's just how the market, that's the nature of investors and how it works, because every time you invest, you become a little bit more savvy, you know what you're looking for, you know what works historically. But even then, you're right, as much as you can do as much due diligence as possible, you still carry a risk of something going wrong. I'll give you an example actually to answer that question. We've got a development in Rotherham city centre, a really nice development. Had no issues with the tenants whatsoever, but we had one tenant who just vacated the property and just went radio silent for 6 weeks with no contact whatsoever. As it transpired, they had a little accident at work, injured themselves,
Can
and they
you
went
hear
back.
us now? Sorry,
Sorry.
I think they are saying they can hear us.
Oh,
Please, can
okay.
you guys hear us now? Or is it just one person not hearing us?
Oh, it is okay. No,
Okay.
it's okay now.
Thank you. All right.
Mhm.
Sorry about that.
So no, that's fine. So how you really manage risk? The only risk you really take is having a void period, and the best way to manage that is have a managing company to look after the properties. Again, because you may not understand the market or marketing techniques of that specific property like the management companies do. So the only risk you really have is if you're taking the burden yourself and effectively feel it's safer or cheaper or cost effective to manage it yourself, but you may run the risk of having a property empty for 2 or 3 months. And that significantly reduces your returns on cash invested, because not only that you've put all this money into a property, but you're now also paying a mortgage for it for 2 or 3 months because there's no tenant in there. So the best way to manage that risk is to cut down the void periods.
Just to cut the voids. Period.
Yes. Yeah. Correct.
All right. So what's the trend that you are seeing in property market right now? What's the trend now?
In terms of location or in terms of buyers?
In terms of buyers.
As in where they're from?
Yeah.
Or what they're buying. Yeah, they're all down south. Again, it's a no-brainer for anybody in London. What we're finding is now, because we obviously work closely with mortgage brokers as well, and mortgage broker data suggests that most of these buyers are now refinancing their existing investments in London or down south. Kent, for example, Bristol's another one, Southampton, and they're reinvesting that money up north. Yeah, you'll find.
You're muted.
To reinvest into other locations, and they're now going into likes of, Leeds, Manchester, anywhere in the north, really.
Yeah. I think this is really true, because the south, a friend of mine just 2 months ago, he got a house there. When we check, yeah, just 2 months. Just 2 months. So it's very true. I think we all have to research. If you want to get yourself, on the property ladder, what you have to do some research, see the future of the place, and the moment you research and know that at the moment the location is very low when it comes to investment, I think it's a good idea. And invest in there, and future you can reap a lot. That's what I think I've seen at the moment.
I think what I find in particular with first-time investors is they're sometimes a little bit hesitant going into location which they're not familiar with, and it's natural. It's natural to do so. I've been there myself. You've been there. It's human nature to kind of have your guard up against something you're not really familiar with. But I think trust is a big factor when it comes to property investment, especially if you're trusting a company like us, like another company. If you have the right people to guide you, to help you understand why they're recommending what they're recommending, it really is a game changer, because you won't know everything about every area out there. But companies like us, for example, who do significant due diligence on any area we take developments on, we do it for a reason. We do it because we've seen a track record of investors make a lot of money. Success leaves footprints, and we follow those footprints. It's as simple as that. For example, we're working on a project in Manchester, in Old Trafford, next to the new football ground. You may have heard Manchester United getting a brand new football ground. So and you've got the likes of Rachel Reeves talking about it in the media. You've got the likes of Gary Neville, for example. There's a big media hype on that. it's the same. The people who are making the new Old Trafford Stadium and doing the regeneration in Old Trafford are the same people who did the same task force who did the reconstruction of Wembley Park. Now they're saying this is going to be on a bigger scale. Now Wembley Park has a track record of capital appreciation to an extent that no one's ever seen anywhere else in the country. So why not follow the third richest person in the country? Why not follow the same task force that's seen it and actually done the work in the past, and they've experienced that growth through the work they've done. So again, success leaves footprints, and smart investors follow that footprint. Some people kind of want to do their own research. That's absolutely fine. But what they find themselves is missing out on opportunities and subsequently settling for the second best. And we see it all the time. And again, I'm not saying it's wrong, because it's human nature to do their own research. I'm exactly the same. Anything I put my money into, I do my own research, but I am guilty of that as well. But what I find now is I'm more open to understanding and trusting people in respective fields, professionals who have a wealth of knowledge and experience in whatever they're talking about, and finding the right person to deal with and trusting them. That works.
Billy, you're so good. You know everything.
I wouldn't say that. I'd like to think I know my field.
Yes,
Yeah.
you do. Whoever that is in this field with you will just give you a salute. And thank you so much for sharing all these deep details with us. We are learning, and we chase you. So what are some of the red flags that as an investor I should look out for in potential deals?
Yeah. The biggest red flag, and this applies mostly if you're buying a property that's under construction, so off plan as we call it, is the developers. Now the developers side of things, you guys may have come across some bad news and press about off-plan properties, in particular in Liverpool, over the past 10 years. It's everywhere, and for anybody who's hesitant about buying off-plan on the back of that news, it makes sense, because what used to happen was you could be a developer, Diana. You could tomorrow set up a development company, take a bank loan, and say, right, I'm going to start building out a 50-story building in this piece of land, which I've owned for a number of years. But what you don't realize is when you go into construction, the costs are never ending, and unless you're forward funded and have substantial capital set aside to complete a project, it can be very, very difficult. Now, from an investment standpoint, for investors would reserve a property, they would exchange their contracts at an X percentage, between 15 and 20%. By this time, you're financially and contractually tied into a property. If the developer then goes into administration, you risk losing the funds that have already gone in it. So to eliminate that risk, you've got to make sure you're working with the right developers. Now, you or investors wouldn't really have the knowledge or the understanding of how developers work, how development finance works, who are the reputable developers, who are the reputable development financiers, and who are their affiliates, who's financially supporting, funding them. So these are all the factors which can make an investment very, very risky. So just to tackle that, what we do is we run a 100-page due diligence report on any developer that we work on, making sure they've got a track record, making sure they're sorry, I've just got a text message. Making sure they're forward funded, making sure they have affiliates in place. They've got finances backing them. So to give you another example, the Manchester project in Old Trafford, we're working with Mayebridge Construction. Now, Mayebridge Construction have actually they're funded by Swiss Invest Corporation, which is a multi-billion-pound financially regulated company with offices in Zurich, Lugano, and London. Now, a company like that wouldn't associate their name and their reputation with a developer if they had any concern of this developer going into administration and risking losing a multi-million-pound project. So for us, them being associated with Mayebridge Limited, coupled with the fact that this is going to be our fourth project with them, with the other three completing at the right time to expected quality, ticks all the boxes. It eliminates risk. Okay. Now, don't get me wrong, tomorrow we could have a financial crisis, the cost of, material goes through the roof, and they could still be in a bit of trouble. But because we know their bank, we know their accounts, we know the financing, they know the funding, that's very, very unlikely, almost impossible, unheard of. So how you really eliminate risk is, or navigate against risk, is making sure you're working with the right developers if you're buying a property off plan. That, I would say, is the most important and the crucial factor, because a lot of people have lost a lot of money working with rookie developers.
Yeah. We just about 6 months ago, a friend of mine lost £11,000 because
Really?
yeah, yeah,
Mm.
yeah, yeah, yeah. There's a house that they were trying to, build.
Mm-hmm. Mm-hmm.
And if she was trying to, because they said if you get it off plan,
Yeah.
it's the best, because but if you invest in it, you're supporting them to build it, isn't it?
Yes.
So
Yeah.
by the time they finish, if the house was like you bought a house 220, let's say,
Mm-hmm.
by the time they finish, it's going to be like 300 and something.
Mm-hmm.
And I think that financially, if you're not prepared, they give you like maybe 6 months to pay it off. They go.
That's right.
Yeah.
Mm-hmm.
But by the time this friend of mine just invested, I think she was supposed to go and they gave her a plan of like paying it off every 3 months or so, and she couldn't get it. And the agreement, she didn't read it properly, so she had to lose that money.
Yeah,
I'm happy that you brought it up here.
unfortunately we see it quite a bit. Some developers would just lie just to get the money. This is another thing. We've got to make sure. The exchange funds, like for example in the case of your friend, it was £11,000. For some investors it's as much as 50, 60, £70,000. And some developers would keep that money in an escrow account. An escrow account is basically a legal solicitor account in which the money sits in until the project is complete. And what that does is it eliminates the risk of you losing the funds if the developer was to go into administration. But a lot of developers don't have escrows now because of the indemnity cover, the insurances, and the fact that they risk not making any money if something was to go down the wrong path. So it's important to work with developers who have escrow accounts and kind of deal with escrow. But yeah, that's, I would say, is the main risk of buying off plan, is working with the right developers.
Yeah. So it's not advisable to get yourself in an off plan buildings.
No, I mean off plan. We work with a lot of, off plan projects. It's making sure that we work with the right developer. That's the most important thing. And touch wood, it stays that way. In my kind of 9 years in property industry, I haven't really worked with a bad developer who's gone into administration or haven't delivered to expected quality. There's been some delays naturally when you're making a 150-story site, and you're meant to complete June next year, and it kind of tickles over to August or September. That's expected in the industry. Even the best and the biggest developers are delayed sometimes. That's natural because there's a lot of external factors that influence the material coming into the country. For example, timber. Most of the timber that comes into the UK comes from Ukraine, and ever since the crisis in Eastern Europe, that timber delivery is now significantly delayed, and that's had a knock-on effect on a lot of the projects in the country and their completion date. So sometimes completion timing is an external factor that's out of our developers' control. But as long as they're forward funded, they have secure solicitor accounts where the money's sat in, and there's a track record of their kind of efficiency and credibility and competency, that's the most important factor, and that's the kind of thing we look for.
But who owes you the right developer? Do you have to do your research to get into the right?
Yeah.
Like, I've come to you, Billy. I know that. Oh, you are good. Mortgage advisor. I've come to you. And I've seen the property that I want to invest in. Are you going to guide me, or I just have to choose?
Yeah. No. We knock back developers on a regular basis. Developers come to us with schemes, off-plan schemes, and we kind of just refuse to work with them purely because they haven't shown any track record. They haven't shown us anything to suggest that they are a good developer, apart from from a piece of paper with some drawings on. So, we're not going to risk our investors' funds into something which isn't stable, which doesn't have any kind of proven record or finance behind it. So before we take on any project, we do a significant due diligence on those developers to make sure everything checks out. We tick all the boxes, and if one of the boxes isn't ticked, we just decide not to work with them.
So, like, say I found a property behind me, close to the train station, that they are building, and I think it's off plan. So I was like, oh, this is really a good area to invest because it's by the train station. How would I know that this off plan is a good investment for me or not? Do I have to Google the builders, developers?
You would have to do some research on the developers, which is why usually it's good to go with a company like us, because we've already done that due diligence on your behalf before we take it on. Because when you do research for a developer, naturally your Google search will take you on their website, and on their website they're not going to talk about anything that's negative that could potentially risk your funds. They would only look at the good, that they'll kind of show the good that they've done, whereas our job is to look at the negatives and understand why those negatives are there. So we kind of go through. For us, it's not developers. Obviously, they'll present us their finances, their kind of track record. That's fine. Anybody can do that. But we question them as to when things have gone wrong, what have they done to rectify that? What processes or procedures they have in place to tackle any obstacles during construction. All of which minimizes the risk for you as an investor. So we look at the negatives more than we look at the positives. Unfortunately, when you're doing online research, you won't really come across many negatives because that's just the way their websites are set up. So even if you do your own due diligence, you still run the risk of missing something which the naked eye can't see, whereas we will be able to with industry experience.
Yeah. Thank you so much. Thank you. So I'm just a new starter. I want to get into investment. What advice would you give to me as a property investor?
My best advice to you would be start. Honestly, that's I get asked this question all the time, and my best advice is start. There are probably people here who are toying with the idea of investing for the past 2 or 3 years, and again, I'd use the metric because it makes sense. 2 or 3 years ago, property price was X. Now it's increased by X amount. For people who are waiting to invest now, will look back 2 or 3 years time and say, okay, if I invested then, my property would have grown in value this much. Nobody has ever looked back and said, oops, I shouldn't have bought a property. You won't find a single person in this country who will say, damn, I shouldn't have bought a property 10 years ago. You never ever hear anybody say that because they have made money in that property, irrespective of what's happened. So my best advice is start. The money's sitting in your account, earning you 2 or 3% on a yearly basis, where it could go into a property giving you 14, 15%, and it's increasing in value. The money physically, and a lot of people don't understand finance and how it works and how the government regulates the money. The average banknote, Diana, you can have £30,000 in cash sat around. If it sits there for 2 years, the bank's still printing off more money and it's losing its value. Buying a property, all you're doing is you're taking that money, you're giving it to someone else, and you're taking their asset. Now that asset is not going to depreciate in value. No one can steal it. It's going to make you money and it's going to grow in value. That's all you're doing. You're trading a physical cash for a tangible asset, which is what the rich people do. So if you look at your, this is a big comparison, probably a little bit out of context, but it makes sense because the wealthy, the 1% of the world get richer because they don't have cash, they have assets, and it's the assets that make them rich. And that's how the world works. It's a monopoly. And if you understand how to play that monopoly, you really break the system. A lot of people think that saving money and keeping it in my account is the best way to go about it. It's not. Your money in your account is losing value. What people do is they buy an asset, which is giving them an income to pay for a liability. Elon Musk, for example, multi-billionaire, doesn't have multi-million sat in his account. He's got assets, and against his assets, he takes loans to pay for X, Y, and Z, because that's cheaper than saving money and paying tax. If he pays tax, he'll pay 50%. If he takes a loan, he pays 3, 4, 5, 6% interest. So it's an absolute no-brainer to take a loan, pay 6%, as opposed to saving the money and paying 50%. It's just a no-brainer. It's, you know, if you understand how money works and how you can utilize the funds that you have, 96% of the millionaires in this country are made through real estate, and if that's a statement to go by, I don't know what is.
It's very true. It's very true. So now, Billy, someone will ask, I have to start. I know that you did mention some of them in our first meeting. For the sake of those who were not there, how does the person start? How do I get the funds? The money is not there. My credit is not good. How do I start, Billy?
So credit isn't much of an issue. It's not a major concern when it comes to buy-to-let properties. Again, I know we touched up on this last time as well, but I'll kind of go through it again for the sake of new viewers. The credit side of things, effectively speaking, the lenders are looking at the property you're buying and the income that's going to generate. So if the income from that property exceeds the outgoing, the liability on the property, then 9 out of 10 times most lenders would lend on that basis. In terms of how you generate the capital, look, some people are sitting on a property which they own and have owned for a number of years, probably have a lot of equity tied in there. A lot of people refinance and pull some profits out, and use that into for another investment, because again, that money sitting into that property is giving you nothing. It's literally it's a dead rubber. It's not making any money. You refinance, pull some money out. Yes, you have a little bit more outgoings in terms of your monthly payments, but then that's gone into a property which is then generating an income for you, which is not only paying for your property investment, but it's also paying for your remortgage that you've done. Yes, you compromise on a little bit of a monthly income, but that's fine because you've got another property you've added to your portfolio, and that money is actually making money for you and increasing in value. See what I mean? So it doesn't really put you out financially. It doesn't put more money out of your back pocket. It just puts you in a position where you've got more assets for the future.
Thank you. Thank you very much.
For example, I'll give you an example.
Yeah.
To buy a property for £120,000, your deposit needs to be around £30,000. Okay. Now, some people would have £30,000 equity in their home. Okay. That £30,000 either sits there, you're doing nothing, or you can refinance, pull that £30,000 out. Now, once you've pulled the £30,000 out, your monthly payments on your mortgage would increase by £200, £300 maximum. I don't think it'd be £300, but just as a worst case scenario, £300. Okay, fine. But the £30,000 then goes into an investment property, which is earning you £800 a month. Okay, now you've got the extra outgoing on your residential mortgage of £300. You've obviously got the mortgage repayments on your buy-to-let properties, which are around £500. So your total outgoing is now £800, which is what the property is generating anyway. So this property that you've just bought from refinancing your profits in your home, the income from that is paying for your refinancing, and it's also paying for your buy-to-let mortgage. Yeah. 10 years from now, you have a property which the tenants paid the mortgage for, and your refinance costs are cleared as well from the tenant, and you've got a property there cashed out. So that £30,000 in the future has set you up basically for your pension.
Wow. £30,000. It's good to know that credit when it comes to investments is different from you trying to buy your own house, and living in that one. They need your good credit report, isn't it?
That's right. So, yeah. Residential properties, they look at you and your personal circumstances, your credit report, how you are with your credit. With buy-to-let, they look at the property.
Just the property. So guys, that's the difference, okay? If you want to invest, it's different from you want to buy your own property and stay in it. And he touched on all of that during our first meeting. So if you weren't there, you've lost. My last but one question to you. What is the interest rate now, and how are we, to benefit?
Interest rates actually came down on the 8th of May. The Bank of England has reduced their interest rates. Sometimes the Bank of England may reduce their interest rate, but the lenders won't. And that really it reflects of basically when banks lend money, they lend from Bank of England. And obviously they have to pay an interest on that lending as well. Now, because over the past 18 months, the interest rates have been so high, the banks are generally recouping a lot of the losses they've gone through over the past 5-6 years, because the cost of borrowing was high. People weren't really borrowing much money. But what you'll find now is even the high street lenders have started to reduce their interest rates. So the cost of borrowing is reduced. And there was a recent article to say that the GDP and inflation has actually, increased by a certain percentage. It exceeded the expectations of the professionals, people who predict the market and the future trends. Now that shows stability. What it also shows is the positivity in the market, and what it also shows is, irrespective of where the interest rates are, people will continue to buy.
Yeah.
We have apparently in the past 18 months, and I use the word apparently because it is apparent that we have had possibly the worst time for interest rates in the past 25 years. And have I seen a decrease in market activity? I haven't, because what you find is smart investors, Diana, would look for and hope for a recession. They would hope for a financial crisis, because they are waiting to jump in at the right time. A lot of the time when you have a recession, when you have kind of instability in the market, people are like, we're not going to buy because the market's too unstable. It is, but that's why you buy, because the market is unstable. You're buying at the bottom and waiting to grow in value. And that's where smart investors make the money. You'll find a lot of these buyers will come in like owls, they'll pounce on these opportunities.
Your mic is off. We don't
I've
want
lost
to
you there.
We want to hear that. Wow. We learned it, guys. We learned it. I'm so happy, Diana's diary has come, to bless a lot of people, and it's blessing me as well, The knowledge is, you can't get this anywhere free. You can't. Yeah. You were cut off. Please, we were enjoying that bit.
No, I was just saying the interest rates are coming down now, and they're going to continue to do so over the next sort of 18 months. But what that means is the property prices are going to continue to go up in effect, because more first-time buyers will come in the market.
Yeah.
The UK market relies on first-time buyers. I think it's the number is around 52% of the buyers are first-time buyers, and you'll find an increasing number of first-time buyers flood the market over the next 18 months, and that's going to give a boost to property market. Now, yes, the interest rates will come down if you wait, but you're probably paying another 10 or 15% for the same property in 18 months' time, as opposed to doing it now. So my best advice would be for anybody looking to start now. It's the window of opportunity over the next 3 or 4 months where you can really secure a good investment and just sit on it and wait for 2 years, and you'll find huge growth in the market. Because if history is anything to go by, this is the exact moment market starts to go upwards, shortly after a change in government, shortly after the policy changes, and shortly after the interest rates drop, with predictions of it coming down further.
Yeah, thank you so much for that, because a lot of people are thinking, the interest rate is too high now. Before, I think 3 years ago, it was a 0.9.
Yeah, COVID. That's never going to happen again. Yeah, that's never going to happen again. That was an anomaly. For anybody who secured a good rate, then well done, bravo.
Even we didn't pay stamp duty that time. So
that's right,
that one is never coming back.
It's never coming back.
So we shouldn't sit there. We should start. So
if you're waiting for that, you'll be waiting a very long time.
Yeah. There's no way it's coming back or whatsoever. So start now.
There's a question from someone.
Flavored Moon.
Yeah, what if you don't have your own property yet? Is it better to invest or buy your home first? It depends on your strategy, it depends on your needs. If you're a family man and you reckon you need a stable home, then I would say buy your first home. But if you have some flexibility, and you don't want to be restricted in a sense, I would say buy an investment, because the investment will earn an income for you. The income you can save towards buying a property. So it all depends on your personal circumstances. But if you want to discuss more, you can take my number from Diana, and I'm more than happy to have a chat with you and kind of guide you in the right direction.
Yeah. Sorry about that.
No, that's fine.
I have to see to baby.
Mhm.
All right. So guys, any more questions? Oh, thank you. All right. Let me ask my last question. What habit or two have contributed most to your success?
Habits, I would say I'm very athletic. I play a lot of sports at a competitive level. For me, it's being in the right frame of mind. I think the mental side of things, the mental side plays a huge part in progress. You find a lot of people with a lot of skill set, but who aren't in the right frame of mind and are unable to kind of portray the skill set, or showcase what they have to offer. So I kind of keep my mind stimulated and my body so I'm working at the most optimal level. So I think for me, my active habits that keep me going is, I'm very active. I'm very outdoorsy. I'm very nature orientated. I'm close to nature in terms of the food I eat, what I drink. I like being out in the sun. I like to travel, like, learn new habits, speak new languages, try new foods, and take active, part in sport. I'm a keen cricketer. I play football. I swim. I play tennis. So I'm always kind of challenging
Always
myself
looking
physically
good.
and mentally. Sorry?
I said you're always looking good, looking after yourself, making money.
Well, you've got to work hard, you've got to play hard. Health is wealth. I had a quote on social media the other day. When your body is healthy, you have 1,000 problems, but the moment your body gets sick, you have one problem and one problem only, and that's your body. So it's the most important factor. It's always overlooked, but the moment you get sick, nothing else matters apart from your health. So looking after yourself, you've got to look after yourself before you look after someone else.
Very, very important.
Mhm.
You see, our senior investor is telling us, look after yourself before the properties. If you
100%.
get all the money
Mhm.
and you ignore yourself, who is going to
Yeah,
look after the property?
exactly.
What
Exactly.
are you going to enjoy? So
Mhm.
please, he's saying we should look after ourselves. It's very, very important.
100%.
Don't take it
100%.
for granted. And I want you to share, that story that you shared with us when it comes to your field of investment, with regards to the success story. You said you
Mhm.
have so many success story,
Mhm.
but a
Mhm.
man that didn't have money to
Yeah.
invest.
Yeah,
Please
Jay,
share that
Jay, one
story.
of my clients. He actually has an investment in the same building as you, by the way. So it says
Yeah.
successfully footprints, Diana. So you're in the same kind of a loophole as him. So for those who wasn't here in the last talk, I have an investor who, from an Indian background, came into the country in 2017 with not a lot of funds to his name. To be fair, he had to sleep quite rough in tube stations for a number of weeks, if not months. But then he was given an opportunity of work, and he worked for 3 years, day and night, non-stop. When I mean he worked, he actually worked. He tells me himself, he didn't socialize for 3 years. It's crazy. Every day for 3 years, every single day, without any breaks on the weekends, he worked, and he saved and he saved and he saved, and he bought his first property. And they say God helps those who strive for better. And he happened to hit a jackpot, because the property he bought in Kent was right next to the new train line where the Folkestone train goes to France. and that went into a total boom just after COVID, where he doubled, tripled his money. So he refinanced and pulled out 220K, 230K profits, and he bought 4, 5, 6 different properties. He now owns, I think his portfolio is around over £1 million, 1.3 million pounds. And he's got 16 properties. He buys 2 or 3 a month, but he's just so focused in building and building and building, and never really settling for what he's got. He could retire now. He's got enough income coming in from the properties that he owns, but he works. He's probably the hardest worker I've ever seen. He works as hard just now as well. He's literally always working. But one thing I find with him is he's a man of his word. He's very punctual. If he has a meeting at 3 p.m., he's got a meeting at 3 p.m. If he wants a phone call at 4:15, you better make sure at 4:15 your phone's going to ring. It's going to be him. So he's very, very organized. He's a man of his words, very, very down to earth, and he's tunnel vision. And not a lot of times I say this, but when I speak to him and he tells me his outlay for the next 2 years, there's nothing in my mind to say he won't get there. He will 100%, 100,000,000% get there. Nothing would kind of restrict him or put any kind of seed of doubt in my mind. I tell him that as well. I said, Jay, whatever you're telling me, I'm more convinced than you are that you're gonna get there, because of your work ethic. So there's nothing stopping you. If you really want something, you can go and get it. It's as simple as that. And if you don't get it, you just don't want it hard enough. It's as simple as that.
You didn't work hard enough.
Yeah.
I the reason why I wanted you to say this story are the qualities, and you did mention the same qualities, because you talked about this man being determined. Mm-hmm. He is a planner, and he's a go-getter.
100%.
Punctual. He's not somebody who procrastinates.
Mm-hmm. Mm-hmm.
So as youth, most of us that watch us are youth, and these are some of the qualities. Billy has dealt with so many people, and he's got a lot of success stories to tell us. But this particular story, if you look at the qualities of Jay, the gentleman he's talking about, someone who is very hardworking. If you are not hardworking, you can't go into this property business.
100%. Hardworking, the right mindset, and he's very given as well. He's very well spoken, very polite. He's a I can try and get him onto one of these shows as well. You can hear it from the devil's mouth himself. He's an interesting character, and but he has big visions and a big future and big plans for himself, and I've no doubt of him not getting there.
Yeah. Giving is good, Billy. His qualities are so amazing. It's so amazing. And thank you so much. Thank you so much, Billy, for gracing our home. I'm done with my questions. Thank you so much for answering them perfectly with all your experiences and your knowledge. We can't get any other person but you,
No problem. Pleasure's all mine.
You're so passionate about whatever you do. So family, this brings us to the end of our investment. If you are thinking of investing, okay, look nowhere else. Just contact me. I've got Billy's number. He's more than happy to help whoever that want to get onto the property ladder. If you want to invest, you have some money lying down, don't look at the money. As he said, the interest rate is coming down, and this is the time we have to start. We have 100%.
Nobody smart leaves their money in their account. I promise you that. That's coming from somebody who works with a wide range of investors. Some of whom have a lot of money, some of them who don't have as much. But money in your account is doing absolutely nothing but reducing in value.
It definitely is. Definitely is losing value. And getting yourself into that property ladder and building up a portfolio, I'll just recommend Billy and his team, because if you find yourself into a team that just need their money off you, take it from me, you will regret. and you might end up, losing your money if you don't have people to support you. And like Billy said, when it comes to lawyers, they are more than happy to get you lawyers that will support you go through, the whole process. And that wouldn't be long. If you say you want your own lawyer, you want your own mortgage advisor, you want your own this, the ball is still in your court. They will leave you. But trust me, if you get a good company like City Rise, I haven't taken no money or whatsoever from them. Yeah, I've got nothing. Billy's my witness. It's just that he's a good guy. He really wants the best for people. That's why he's here. But I'm just using my platform based on my experience with them, just to encourage anybody that want to go on that property ladder. If you want to invest, okay, just contact City Rise. Get Billy's number from me, and I'm more than happy when you call Billy. He's more than happy to speak to you, go through one-on-one discussion free of charge.
Anytime, guys, any time of the day or night. I'm pretty flexible, so whatever suits you, just let me know.
Yeah. Okay.
Okay.
Thank you
Perfect.
so much. Thank you, Billy. Thank you so
No
much.
problem. Thank you, guys.
My hair, as usual, is by Edna. Thank you so much. He got my hair always looking fly. My earrings is Abby's collection. And tomorrow, family, we've got an insurance guy. Billy was telling us, if you rent that property, there's a lot of people that are out there. And this gentleman tomorrow is going to tell us a lot about insuring your house, your property, getting laws and all that. He's a good guy, and he is also helping us through this journey of property and stuff like that. So I'm reaching out to people that I know for now, and like Billy said, he's going to bring someone important that we can also learn from. If he gets agree, we will be more than happy. But at the moment, whoever that I bring on Diana's Diary, know that person is very, they are potential people. They are people that is, credited. They haven't taken no money from me. They haven't taken anything. It's just that I want to support people. And this is how the world should be. We should, if we have any knowledge, don't let somebody go out there, go and take risks and have bad experiences. If we were to share our experiences with one another, I don't think we'll end up like this. If your friend is to tell you what really helped her, I don't think that the world will be in a mess. So Diana's Diary, I thought of all my friends. I'm thinking of you, and I'm bringing people that can help you. Okay, so take advantage and every bit of opportunity here and get yourself up on that ladder. The property business is booming. Billy has told us everything. Please don't waste time. Start. Thanks for joining us tonight.
Thank you. Cheers, guys. Thank you. Bye. Bye.
Bye.